back, everybody. This is episode 2 of the Wall Street Journal. A few housekeeping things before we get started. First, welcome back to those who have been with us for a while, whether you started following me on X or Substack or somewhere else. It's good to have you back. Thanks for rejoining. And for people who have recently joined, welcome. If this is your first time watching or consuming any of our content, it's good to have you here. So one thing I do want to mention is I have been in talks with Alex over at Macro Ops for some time about doing some sort of partnership slash collaboration for the Macro Ops community. The Wall Street Journal is basically what I pitched to him as something that would fit for both my community and also potentially for his community. So anyways, that's why we decided to do this kind of collaboration. So if you are seeing this because of your interest or following up the Macro Ops community or Alex's work or Brandon's work or Chris's work, welcome. It's good to have you guys here. And we will continue to post these to the Macro Ops YouTube and maybe other forums as well. So so you should be able to pick up this content there. Just for more direct access, you can also follow me on X and Substack. On X, I am at VIXed Signals, VIXED SIGNALS, and on Substack, I'm at the Free Dominion. I will include links to those at the bottom of this video. So anyways, welcome to everybody. We are excited to be working together. And before I jump right into the charts right now, there's just one other piece of housekeeping, and that is there will be no Wall Street Journal next week because I am going chukar hunting in the hills of Eastern Oregon. So I'm going to be offline next weekend. So anyways, with that said, it's time to get going. So let me shrink this video. Like I said in the last video, or in the note of the last video, I am really just starting to get into the whole video editing thing. So I assume the quality of these will get better over time. Anyways, to get started on the volatility stuff, this is I'll call it my primary home screen. Those of you who've been watching for a while should be very familiar with this. The top pane is the VIX. The bottom pane is the VVIX. Then right here, the next pane down is the implied volatility of the entire VIX options space. The next one down is the 10-period correlation between VIX and VVIX. And down here is the price ratio of the VVIX to the VIX. So just a quick primer for those who are new and learning about volatility. The VIX is a calculation based off of the S&P options, roughly 30 days to expiration. The VVIX is the same calculation, but it is based on VIX options. The implied volatility measure, this is a wider measure of implied volatility across all of VIX options. The reason I watch the correlation between the VIX and the VVIX is because they tend to move together. And so when they are not moving together, I see that as a potential warning sign. Maybe not a warning sign, but often I'll describe it as I see it as pressure building in the system. And then this bottom price ratio down here of VVIX to VIX is just another way I track how they're moving relative to one another. So when this line is moving higher, it tells me that VVIX is outperforming VIX. And when it's moving down, it tells me that VIX is outperforming VVIX. So things that I look for would be if this line is rising, so VVIX is outperforming VIX and the correlation is coming down, that's telling me that VVIX is starting to climb higher, or at least not drop, while VIX itself is coming down. And sometimes VVIX can be a very good signal or preemptive signal that something's going to happen within the VIX or the rest of the VIX complex before it actually happens. So that's why I consider this my kind of main screen. It kind of captures most of the relevant things that I like to watch. So let's take a look at this week. This is a daily chart. So these first 5 candles go back from Monday to Friday. I've been highlighting both in writing on X, Substack, and also in the videos that this 16 level on VIX has been very important. Well, it continues to be very important. As you can see, we kind of dip a little bit on Monday, pop back up, and we just hung around 16. We tried to push higher on Friday, and we kind of came back down. Equally as important is this 95 level down here on VVIX. As you can see, we came down to 95 on Monday and spent the rest of the week drifting higher. As we move through the week, we can see that this correlation down here started to roll over. And that was because VVIX was basically pressing higher more consistently than VIX was. It's very subtle, which is why this is hasn't really dropped too far. And we also saw at the beginning of the week, VVIX had been outperforming VIX, but then it started to roll over as VIX caught up. So my takeaway from this was that 16 and 95 are still very relevant levels. And also that VVIX was a little bit firmer, held a little bit firmer than VIX did. We can see this on Thursday where VIX dropped down basically to the Tuesday lows, a little bit above the Tuesday lows, but definitely below the Wednesday lows. And yet VVIX, especially compared to Tuesday, actually I'm seeing this wrong, so sorry. I was looking at the wrong thing when I first looked at it. But anyways, my big takeaway is that VVIX has been a good signal so far, and that it has stayed above 95. This is the point I was trying to make, was that on Thursday, VIX came back down to 16, but VVIX didn't come back down to 95. Now, I don't read like too much into those specific like details, like, oh my God, VVIX didn't hit 95, something's wrong. It's more just this kind of relative action. And if you watch the previous video and other videos, you'll hear that I talk about relative action a lot. Sometimes it's relative action between VIX and VVIX. Sometimes it's relative action between VVIX and the VIX futures. Sometimes it's VIX and the VIX futures. Sometimes it's the VIX and the S&P. I'm always just watching how they're acting relative to one another, because when they start to act differently or outside of how they have been acting, it can be an early tell that something's going on. One other thing I want to note is that this is just the way I do it. I've been watching the volatility markets really since kind of 2018, so I am by no means the most experienced person in this realm. I just have been watching them for a very long time, and everything that I share with you, whether it's just flat up indexes that I'm watching, or ratios that I've either created on my own, or that are or other instruments that others have created, these are just things that I have compiled over the years that I have found can be very telling. And really, I use this whole system to kind of paint a general picture for me of how healthy the market is. I want to see if the market is resilient, if the market has kind of almost cushion built in it to absorb the inevitable bumps along the road. And another way to think about this is, oftentimes the VIX is called the fear index, and I think that is just too, I don't know, there's not enough depth to it, because the VIX doesn't always just tell you that there's fear in the market. So even this week, we can talk about that, and I'll get into it a little bit later when we look at some of my skew measures. But the VIX doesn't just go up when the market is fearful. This week in particular, we did see, and we've been seeing, market up, vol up action. So the VIX has been going up while the S&P has been going up. And that isn't necessarily a bad thing. I mean, I do see it, again, it's another way that I think of like pressure building in the system. And sometimes market up, vol up action does lead to market down, vol down action, which is also kind of surprising and out of the norm. But really my point here is that just calling it the fear index can be misleading. I've heard other folks describe it as like a thermometer, which I think is also, I think is a far better description. A thermometer being like one that you take that tells you if you have a temperature or not. So if the VIX is telling you that the market has a temperature, like, oh, the market might not be that healthy. This is probably getting a little nerdy maybe for those people who are kind of really into their health and wellness, but I think of the VIX actually more as like your heart rate variability. So if you don't know what heart rate variability is, just go Google it. But it's a subtler way to determine kind of your level of general, I don't want to say just health and well-being, but I use it as a way to measure my kind of general recovery. And so you may hear, like right now, I'm a little sick. I've got a 4-year-old, so there's like a rolling cold that runs through our household at all times. And my HRV, when I measure it every morning to kind of test what my recovery is, it will start to tell me ahead of time, before I even know I'm getting sick, that like something's going on in my body. If I didn't get a good night of sleep, or if there's a kind of a cold coming on, or if I've trained too hard, or whatever it may be, my HRV picks up on it and will tell me. So anyways, I kind of think of the VIX as like the market's HRV, because it can really kind of tell you the whole VIX complex, not just the VIX. There's a lot more to it than just the VIX, but I'm kind of using it as this measure of the market's HRV because it can sometimes really give you a heads up of like something's just not right. The market just doesn't feel right. It's not super healthy or whatever maybe. Or it could be telling you like all is good. And so if turbulence does hit the market in a case where the HRV or the vol complex is saying the market's very healthy, I don't panic. I don't get worried because I know that the market has some resilience built in and it can handle this. And when those shocks hit or that selling hits or whatever it is, then I'm watching to see does the kind of HRV of the market start to tell me this, that the health is deteriorating. So anyways, kind of a bit of a tangent there, but I thought it might be helpful, a little context for why I do watch this stuff. But the main point is this is what I do. It doesn't mean you have to do it. There are people who are far smarter than I am, who have been working in this for far longer than I have, who see different data, who see better data, that are going to have different perspectives, who, things that I see as warning signs, they may see as like the opposite. And so anyways, take from these things what you like, ignore the things you don't like, ask questions, make comments, make recommendations, tell me where I'm wrong. I'm always looking to learn. This has just been what I've compiled over years and years of looking at this stuff, but that does not mean it is absolutely correct all the time. So anyways, that was kind of my read on the market this week. Vols have just kind of been stuck. They've been holding firm. When vols are firm like this, even though the market is grinding higher, and we saw, we had a lot of events come through in the past kind of week to 10 days. We got through the FOMC. There was no surprise there. We've gotten through the kind of Trump, China tariff stuff a little bit. There's more clarity there. We're getting through earnings, all the big mega cap earnings that came out this week. We've been getting through those events, and it's been kind of, I'd say, a mixed bag, but getting beyond FOMC, seeing some clarity on the geopolitics front, and getting beyond the mega cap earnings, or most of them, with most of the earnings being at least pretty decent. Getting beyond that, in my mind, could have, maybe should have. I don't like using the word should. But it could have led volatility to come down more. So the fact that vols have remained firm throughout all this is somewhat telling. Even if the VIX getting pushed higher is because of calls getting bought as opposed to puts getting bought, that doesn't necessarily mean all is good. So when vols are acting like this, it certainly has my attention, especially as the market is moving to all-time highs. So let's jump over to the S&P and see what we see there. So I'm going to switch to the daily chart. So the S&P starting this week was right here. This was Monday, so we pushed higher. We had new highs on Monday, Tuesday, Wednesday, Thursday, and Friday. We dropped off, kind of chunked around. But we are in a bull market, folks. So argue with it however way you like to. But if you are shorting here at all-time highs, good luck to you. So anyways, looking further down, this is the 3-month implied correlation measure. So I look and talk about implied correlations a lot. This is the 3-month measure. I also look at the 1-month measure. But implied correlations, as I've been mentioning on X and on Substack, have gotten really low. And when they get that low, it can just be a sign to like maybe take your foot off the gas a little bit, because when volatility is relatively low like it is and implied correlations are this low, an increasing in implied correlations can be what snaps the volatility measures higher. And we saw that back in early December, where if you're looking at my cursor here, we were really low in implied correlations. And then when implied correlations spiked, that was on October 10th, that corresponded with the sell-off in the market. So as you can see, this week, implied correlations climbed higher. I would say they outperformed volatility, and we'll look at that in a different way later. But these implied correlations starting to climb, corresponding with the market kind of, I'll say, rolling over. That I wouldn't go, that's not to sound dramatic. I mean, we're just slightly below all-time highs. But, this is certainly something that I'm watching here. And another thing that I talk about a lot is overvixing and undervixing. And I had a question about this that I actually still need to respond to after a post earlier in this week. But as you can see here, so this is the zero line, this dotted line. Anytime this black line is above the zero line, that's overvixing. Anytime it's below, it's undervixing. So over and undervixing, all I'm talking about is this calculation is based on a regression of between the S&P 500 and VIX movement, looking back a very long period. So it's, again, I hate to use this word, but it tells you what the VIX movement should be based upon a move in the S&P. So if the VIX moves more, so it can be kind of two ways. If, let's say, the S&P is falling on a given day, and the VIX moves higher than the respective S&P move suggests that it should, that would be overvixing. It can also be if the VIX drops less than it should, that would be overvixing. And the opposite is true. If VIX moves less than it should, based on an S&P move, that could be undervixing. And then in the same light, if it moves more, I'm screwing this up now. I'm confusing myself, and I'm sure confusing you as well. Anyways, I'm using this measure to judge how much the VIX kind of should or shouldn't move. And what I do is I look for extreme readings. So if we look back on October 16th, where we see here, we popped up into this green area, which is above a 2.5 measurement. That was overvixing. It was very quickly followed by undervixing. So I look for these extreme readings because they can kind of signal to me that like we've officially had like a vol event. And when you have a vol event like that where VIX really overreacts, it's quite common to have an underreaction. And what I do is I look at a 10-day summation of the over and under VIXing to kind of get a read of cumulatively how much over and under VIXing we've been doing over a 10-session period. And so I will actually slide this over so you can see this. It's going to probably look a little bit noisy, but this is a calculation I run every day. So I input the S&P, the VIX, the front month future, and the second month future. But what I want to highlight is this section right here. So this top line here is my over-under VIX calculation. So positive numbers are overvixing, negative numbers, like on Thursday, are undervixing. And then this is a 10-day summation, this middle line of over and undervixing. And then I have a 1-year percentile running. So looking back to early October, where we had the volatility spike, we really started to overvix on 10-10. You can see we jumped here. This is 1.4 is a pretty high reading. And that kicked off a cumulative high reading in the 10-day summation. So you can see the 10-day summation jumped into over 3, which point we were in the 94th percentile. And this kind of preceded and led into this big overvixing on the 16th, where we reached the 6th reading on the summation, and that pushed us into the 92nd percentile. Then we really undervixed, and that helped bring it down. But as you can see, since kind of mid-October, these last 2 weeks of October, we've really started to moderate. So a little undervixing, a little overvixing, and the summation really started to flatten out. And then here, we dropped into pretty severe, I won't say severe, but very low cumulative undervixing. We can see we dropped from the 50th to the 19th percentile. And that's just because this reading popped off, or one of these readings dropped off the summation. So I don't read too much into that, but as you can see, since the big vol spike in the middle of the month, we really have moderated. And then we're now down as of Thursday. Again, we were dropping into pretty low percentiles of kind of cumulative undervixing. But so I'm looking for this coloration goes from green to yellow to red. So if it's a very high cumulative reading, so the top 1/3 of readings, it turns to green. If it's kind of the middle third, it's yellow. If it's the lower third, it's red. So when I really, stable market to me is consistently seeing yellow with jumps up into low green and drops down into low red, or high red rather, and just seeing this percentile kind of in the 35 to 65% range is what I see is pretty steady. So we've really steadied a lot in the past week to 10 sessions. So anyways, I will minimize that. So anyways, that's the over under VIXing. To me, it looks like I was just saying, things have kind of moderated and we're looking a little bit more stable now. This is another thing I watch. This is the CBOE VIX term structure, so different than the VIX futures term structure. So this just looks at the different VIX calculations that the CBOE does. So this gray line is the 1 day, then the 9, then the 30. So this is the actual VIX that we're all used to looking at. This is the 3 month, this is the 6 month, and this is the 1 year. So I'm looking for how these are all moving relative to one another. The 1 day and the 9 day kind of do their own thing. Like we saw most of the vol complex kind of climbing higher most this week, whereas the shorter term stuff dropped off. That could be tied to the fact that we got through FOMC, we got through the China, US stuff, we got through earnings. But I do look for when they start to cluster like this, that can be a good signal. And the same as with the VIX futures term structure, when these shorter term measures jump above the higher term measures, to me that is a sign of backwardation. So And so I'm always looking for that. It's very rare for this to, flip into complete backwardation. I'll see if I can zoom out here a bit. You can see back here in April, I'll zoom in, but we got pretty well backwardated here where gray was above black, black was above blue, blue was above purple. You can see so this is fully inverted. And then it pretty quickly gets back to kind of the normal term structure. So I keep an eye on this. Don't really use it except for when we start to see clusters like this. But anyways, it's nice when things are pretty well spread out. It tells us that there's nice kind of stratification across the VIX term structure. Okay, so I'm going to move ahead now to vol components. So as you're going to see with these videos, I'm basically going to run through the same stuff every week, and then I will highlight things that were the most important. So looking back to this week, we're starting right here. This was Monday. So again, just as a little reminder, the orange line is the VIX EQ. That's individual, or it's rather the S&P 500 constituent volatility. So basically individual stock volatility. The pink line is the dispersion index. So that's measuring how individual stock volatility is moving relative to the index volatility. Black line is the VIX, and the blue line is 1 month implied correlation. So in the other chart, we were looking at 3 month implied correlations. I look at 1 month implied correlations here because all of these other measures are on a 1 month basis, basically. So VIX is 1 month, dispersion, and VIX EQ are all looking at 1 month implied volatility. So I look at 1 month implied correlations here. And the thing to point out, which I pointed out earlier, is implied correlations started to ramp up this week. And we got down below this very low level that I was highlighting last week at the red line. Implied correlations started to climb. We see that puts upward pressure on the VIX. At the same time, we saw individual stock volatility drop off. That makes sense because we were getting to the end of earnings now. Individual stock volatility tends to get bid during earnings, meaning bought. So there's upward pressure because there's a lot of volatility that happens coming out of earnings reports. And so ahead of those events, market participants will be buying hedges, they'll be buying upside exposure in calls, and so you'll see implied volatility on individual stocks climb during earnings season. Then after earnings season, there's like this kind of release of implied volatility. So honestly, and that can impact, trading options around earnings can be very difficult because you could see, let's just say you buy puts on, I'm making this up, but Tesla, and Tesla drops 5% after earnings. Well, just getting beyond the earnings itself can pull a lot of the implied volatility down. So even if Tesla drops in the same direction that you've bought puts, so if you now have puts that the market has moved in your favor, the drop in implied volatility just by getting beyond earnings could actually be a really big drag on the performance of those puts. So the high implied volatility is going into earnings, and that's the same kind of on an index level basis too. Going into big events that are known, like FOMC meetings, CPI prints, whatever it may be, and I've talked about this before, just getting past the events itself, regardless of what happens in the events, can really weigh heavy on volatility measures because you'll see the VIX kind of get bid up going into events. And then as soon as the event is over, and less on the VIX because VIX is more 30-day, but you can see it in the short-term measures of volatility where the 1-day VIX, the 9-day VIX starts to really ramp up. That's kind of what I was saying. Those measures kind of do their own thing. They're much more sensitive to what's going on in the here and now. So you can see those measures start to go up into events. And then once the event is over, regardless of what actually happened, the implied volatility will come off. And so you could see, VIX futures start to pull back or other measures of volatility. So anyways, this week we started to see the inverse action of what we have been seeing. So as opposed to implied volatility of individual stocks climbing, which we've been seeing now for months, and implied correlations coming down, we did have this spike here. This week we saw the opposite. We saw individual stock volatility come down. We saw implied correlations come up. And we saw the VIX just kind of continue to move sideways. Down here we see the VVIX. We can see there's another good example of how it has been climbing. And then right here, this line is the VIX EQ, so the individual stock volatility minus the index volatility. So we've been seeing for quite some time now, since early September, individual stock volatility way outperforming index volatility. So that's been on a lot of people's radars. And since in the past week, this past week, we saw that reverse as individual stock volatility really started to cool off. So anyways, let's move on to some of the other things I watched. This should be relatively quick. These are two different measures of demand basically for hedges. And so we saw those start to climb higher this week. We also see this is a measure of the VIX term structure. So this is kind of short-term volatility minus mid-term volatility. And so when we see this climbing, it's showing us that the term structure is steepening, which we like. So we did have a bit of a reset here. But since we've been basically pushing higher, we came down a little bit over the course of this week. We did see a bid down here. This line going up tells us that, I walked through this last week in last week's video, but if this line's going up, it's telling us that bid for out-of-the-money options or out-of-money options are outperforming at-the-money options, which can be a signal of demand for hedges. So we can see that happening here, see that happening here, and we can see that happening here. So going into the end of the week, we definitely saw some interest in buying some protection. Here we've got 3-month implied correlations. We've got 1-month implied correlations. We've got the VIX. We've got the correlation between the VIX and 3-month implied correlations. So the fact that this is starting to roll down has basically been pointing out that 3-month implied correlations are really outperforming the VIX right now. So you can see this is kind of, I don't say screaming higher, but it's moving decidedly higher, whereas the VIX is still kind of chopping sideways. That's something to keep an eye on. Usually these track pretty closely. As you can see, most of the time, this correlation line is very high. The fact that it's coming down is something to keep an eye on, especially if it starts to make it down. It's way down below this red dotted line, which is just a line that I've identified as kind of a tipping point. And then down here we have the dispersion index and its correlation to implied correlations, which I don't really get too much out of this measure. So we will move on. I've mentioned this one in most of the videos. This is looking at high yield credit spreads. So high yield credit spreads is a way to measure the risk that the market is assigning to lower quality credit. So relative to high quality credit, things like treasuries. So when credit spreads, in this case, the spread between the yield, the interest rate paid on high yield credit versus the yield on higher quality credit, as this spread is decreasing, it's saying that the market is assigning less risk to higher yield credit. And so that's saying that the market is feeling more comfortable that conditions are good and healthy. And I'm probably oversimplifying this. This is not my area of expertise by any stretch. This is just a simple way that I look at it. And so when credit spreads are tightening, that's generally a healthy thing because the market is saying, hey, we're comfortable taking on additional risk in high yield credit markets relative to lower yield, lower risk credit markets. When we start to see high yield spreads widen, that means the market is demanding a greater premium to put their money into higher yield, higher risk credit. And so as the spread is widening, that can be a sign that there's some discomfort in the market. Again, I'm oversimplifying here. I like to watch the correlation between high yield spreads and the VIX because they usually move together very closely. So spreads tightening, i.e. coming down, usually corresponds with the VIX coming down. Spreads widening, i.e. going up, usually corresponds to the VIX going up. So I like to see high correlation measures between high yield spreads and the VIX. And right now we have that. As you can see when I'm circling right here, correlations are quite high. So that's a good thing. When they drop down here, like I've highlighted in other videos, that can be a warning sign. And so then I also like to look at the correlation between high yield spreads and the S&P 500, which is this line. So I highlighted this last week that we see the correlation climbing here, and that's because the S&P is still going up, and we see that credit spreads have a bit of an upward bias to them now. Yes, they came down for 2 weeks in a row, but then this past week they climbed again. So as you can see, we've got higher lows so far. If you were to draw one line here, it would be this line underneath. I can do it here. Try to do it here. There we go. So that's why this correlation is climbing, and that's certainly something that I am keeping an eye on. All right, last one on this set of slide or set of charts. This is looking at the 3-month VIX minus the VIX. So this staying above the red is what we want to see. When it drops into the red, that is telling us the curve has inverted. This moving higher tells us the curve is steepening, which we like. This one down here, this is the same measure that I showed before. Again, we want to see it rising. That's steepening. That's good. And I highlighted this on an earlier chart. This is looking at the VIX minus the individual stock volatility. So the fact that this is climbing now, this is actually the opposite of what I showed earlier. The chart I showed earlier had this mostly moving bottom left to top right. This is showing more top left to bottom right, although we now see that the VIX, so index volatility, started to outperform individual stock volatility. I'm now going to go to the last thing, which is the VIX futures term structure. So in the upper left, we have the front month. This is November, the November VIX futures contract. Top right is December. Bottom left is January. Bottom right is February. So I'm at all times watching how these front four contracts are moving relative to one another. The front of the curve tends to move more than further out the curve on any given day because it's closer. It's the front of the curve. It's closer to expiration, so it's going to be more sensitive to what's happening in the day in and day out. And so, if we're looking at these values, November is currently at 1910. December is at 1987. So what do we have? 77 bips or 77.77 vol points between the two of them. Not super steep. We're still in contango. Contango meaning this is lower than this. December is lower than January. January is lower than February. We can actually take a look at that if we see if I can get this. Actually, I could do it another way too. Sorry, Thinkorswim's lagging a little bit. They must be doing maintenance. Let's see if we can get it here. Anyways, okay, we'll focus on this and I'll revisit that. But I was going to show you just the VIX futures curve. But anyways, what we saw this week, similar to VIX and VVIX, is that the VIX futures were pretty firm, although the VIX futures actually, they were pretty decisive in their climbing higher. This purple line marks where I actually bought the November contract. The reason I bought it was because I was just seeing that VVIX didn't want to go down. Like, even as the market was hitting all-time highs, like the VIX and VVIX were just kind of holding firm. And so on Wednesday was the FOMC day, and the fact that the market kind of got what it was expecting, which was a 25 basis cut in the rate. Although it was kind of like a hawkish cut because Powell said that the December rate cut is not by any means kind of written in stone. So the fact that the volatility complex and VIX futures closed higher that day was enough for me to put on a little bit of a hedge. So I actually got long November VIX futures, and my stop loss will be a close below the low. Actually, I'm not going to use the close. I'm going to be one tick below the low from Monday, which was the 27th. So I'm not thinking that there's going to be some huge volatility event, but I've got a fair amount of exposure long equities. So to me, this is just a little bit of a hedge. In case volatility does start to get a little erratic, and part of that was also due to the fact that implied correlations were so low that I thought there was a good chance that implied correlations were going to start to climb, and that could add a little boost to volatility. So far we've seen that. It came off the high on Fridays. We have seen the curve steepen over since the bigger sell-off in mid-October. The curve has gotten back into contango and looks decent, but this is certainly something that has my attention when I'm always when I'm always on the lookout for sorry, let me clear these out. So what I'm always on the lookout for, and I guess I will add one for last Friday. So let's put this to the 31st, and sorry, bear with me. This was so this kind of yellowish green line was from Friday the 24th, and sorry, I did that wrong. Oh, it is okay. And this red line is from Friday the 31st. So this is what happened to the curve over the course of the week. And as you can see, we went from, the curve basically lifted a little bit higher. So we went from 1932 on the December contract to 1955. So we added about 0.2 vol points. It looks like it was kind of similar across the board. So, volatility did move up across the curve. It looks like the curve is basically kind of the same steepness, like the contango did not change too much. But anyways, yeah, the fact that volatility moved higher this week is certainly something to keep an eye on. But to wrap things up, I would say, overall, markets still look pretty healthy. Whenever you're kind of chugging along at all-time highs, it's really hard to be too bearish, at least for me. The volatility complex looks like it's, it's kind of on its toes. It won't fully relax, but it also hasn't given any obvious signs of panic. The fact that the futures curve is still in contango, meaning it's upward sloping, that adds a kind of downward pull over time, especially as spot VIX stays below the curve. And so, yeah, I'd say it's kind of like, until volatility really tells us that, something's vulnerable, which in my mind would be the futures curve really flattening out and looking like it has the potential for spot VIX to jump above it. Until we see that, I just have to, I have to tip my, I have to, give bulls the benefit of the doubt. This actually just reminded me one thing I did want to point out. I mentioned it earlier. Might look a little bit noisy, but I have a very simplified version or calculation that I use to look at skew. And so skew in this context, I'm looking at S&P 500, basically the implied volatilities of at the money, out of the money, and then deep out of the money puts and calls. And so what I'm looking for is, are there changes in implied volatility that can give me some insight into where the demand is for these various products? So generally speaking, there is put skew, meaning that puts are more expensive than calls. And that's because people want to own puts as protection. I look at this on a fixed delta basis and also a fixed strike basis. And so for the fixed delta, every day I just look at what was the IV for the 50, the 25, and the 10 delta calls and puts. And for those who don't follow options too closely, that probably sounds like Greek because it actually is Greek. If you have questions about that, just ping me, let me know. And then on fixed strike basis, what I do is every Friday, I look ahead 30 days at the expiration. That's 30 days from that Friday, and then I look at the roughly 30 delta puts and calls, and I mark down what the IVs are on Friday, and then I track those strikes throughout the course of the next week. And so what I want to point out here, and I'm going to go over to the graph because I think this will show you the best illustration. And I've only updated this through Thursday, but what I want to point out is this purple line dropping. Sorry. You can see this purple line dropped pretty significantly. We see this blue line, this orange line, and this green line. All of those dropped a bunch on Thursday. And the reason was because the implied volatility on calls jumped up while the implied volatility on puts dropped. And so whereas I was saying before, puts are usually more expensive, and when I say expensive, I mean the implied volatility is higher on puts than calls. What happened this week on Thursday was the inverse. There was a big push up in implied volatility on calls, and there was a drop off in implied volatility in puts, which suggests that there was buying of calls and selling of puts, which is usually the opposite of what we see. Again, I'm generalizing here. So what I want to point out is on the 30th. So this number right here is the 50 delta call. So if we look from Wednesday to Thursday, just follow. If we went from Wednesday to Thursday, the call IV on the 50 delta call, roughly 30 days on the S&P, went from 13.18 to 15.92. So that jumped almost 3 vol points. The 25 delta call went from 12.11 to 13.43, basically 1.5 vol point increase. The 10 delta, so the way out of the money calls, went from 11.85 to 12.50. So over half of a vol point jumped from Wednesday to Thursday. Looking at puts, so at the money 50 delta puts went from 14.40 to 12.14. So that dropped by more than 1 vol point, 1.5. The 25 delta, so kind of out of the money, not super out of the money, not deep out of the money, went from 17 to 15.40. So again, more than 1.5 vol points. The deep out of the money puts went from 20.80 to 19.27. Again, more than 1 vol point drop. So we saw this is fixed deltas. The calls went way up from an IV standpoint, and the puts went way down. So we can see the skew, the 10 delta skew. So how expensive are the puts relative to the calls? Went from 0.6 to 0.56. The 25 delta went from 0.34 to 0.16. You can see I color code these two by the kind of 1/3, like the 30th percentile, the 66th percentile, and the 99th percentile. So if yellow is kind of average, green means it's a high skew, and red means it's a very low skew, very flat skew. So we went from 0.34 to 0.16. Jumped from green to red. And then on the 50 delta, we went from green to red. It went negative. That means the calls of the 50 delta calls at 15.92 are higher. The IV was higher than the 50 delta put IV. That's very rare. This is, I think, the second lowest reading I've seen in years. The 25, then these other ones are actually just other measurements that I won't get into. Then if we look, this is my fixed strike matrix. So down here, this week I was looking at the 69.50 call and the 66.60 put. And so we started the week at the IV on the call was 1082. The IV on the put was 15, basically. The big thing I wanted to highlight was what happened on, again, Wednesday to Thursday. So we went from the fixed strike, so this is the 69.50 call, went from 1293 to 1438. It's a big jump. And the 66.60 put IV went from 1760 to 1548. Again, over 2 vol points shaved off here. So what that did, by the calls getting so much more expensive and the puts getting so much cheaper, the skew went from 136 to 108. That's a big drop. If you could see here, this red, very rarely, this is going back years, if you're looking just at this fixed strike skew line here, very rarely does it get down into the red. So that's why over here, we see these lines drop off so much. Anyways, I know that got kind of a little wonky in the details. You may not have followed much or all of that. I hope you did a little bit. But it was just to point out that, like, as that was happening, you know, we were seeing calls get pushed way up. I'm going to go back to the VIX. This will be the last thing we look at. So what was the VIX doing on Thursday? The VIX was up. The VIX opened at 1626 and it closed at 1691. So on a day that puts basically lost value, the VIX went up, which is just a good indication of how the VIX isn't just driven by puts. That call buying can also drive the VIX higher. And we did see VIX futures down on Thursday, which, again, I'd say the VIX futures are because VIX is just a calculation of options values, whereas VIX futures are driven also by supply and demand. The fact that VIX futures came down that day was more telling to me. VVIX closing up on the day or kind of flat on the day, somewhat interesting. VIX futures closing down is what I would expect because, you know, the market wasn't in panic mode. If anything, it was like there was like this desperation to buy calls. So anyways, just wanted to highlight how the VIX, again, coming back full circle to what we talked about before at the very beginning, the VIX being called just a simple fear gauge, I think is misleading. In this case, the VIX went up, yet it was because there was demand for calls, not demand for puts. So it wasn't panic buying of puts because people were scared. There was, I won't say panic, but there was strong buying of calls because people wanted upside exposure. Now VIX going up, going back to the HRV thing, that would tell me like something weird's going on. Like it's not normal. I'm not saying it's bad. It's just different. And so in this case, the VIX, the HRV did pick up on that something was kind of going on there. But anyway, so that is it. Thank you for coming to episode 2, for watching. If you have any questions or comments, please do follow up on the comments on YouTube, the comments in Substack, hit me up on X. So you can check out at VIX Signals. You can check out at Wall Street J. You can check out the Free Dominion on Substack, and we will include links to all of those at the bottom of the video. So again, thank you for coming, and remember, we will have no video next week, but the week after that, I should be back. So until then, be safe, and I will talk to you soon. Bye-bye.